Welcome to episode 15. This is a discussion of Chapter 15 of UAE crypto litigation, available at www.uaecryptolitigation.com.
Thank you.
So imagine checking your digital asset portfolio, right? And you realize a significant sum of your money is just completely gone.
Yeah, that is a terrifying scenario for anyone.
It really is. And to make matters worse, the person who took your funds is now claiming your investment contract never even existed.
Oh, wow.
Yeah. So today we're doing a deep dive into exactly what happens when crypto promises just evaporate. We're looking at whether the law can actually reach into an unlicensed manager's pockets to get your capital back.
Which is such a fascinating intersection of, contract law, evidentiary standards, and regulatory frameworks.
Exactly. We're focusing specifically on the enforcement of unlicensed investment management agreements.
Right, because that scenario gets right to the heart of foundational commercial risks. We're really looking at the severe dangers of informal financial activity.
Especially in an asset class as modern and, well, complex as digital assets.
Oh, absolutely. I mean, we consistently see situations where an individual basically sets themselves up as an informal investment manager.
Right.
They take funds from a client and promise to actively trade those funds across multiple volatile markets, so typically crypto, equities, and foreign exchange.
And in the specific commercial problem we're dissecting today, this informal manager makes a very, specific promise. They promise a guaranteed, exceptionally high quarterly and annual percentage return.
Which sounds incredible on paper.
Right. It's the kind of yield that easily attracts capital. So the manager takes the investor's funds directly into their own personal bank account.
A huge red flag right there.
Massive. And they pay out one single partial installment of the supposed profits, and then nothing. All payments just simply stop.
And let me guess, when the investor finally confronts them.
Yep, the manager claims the written agreement is invalid. They actually deny ever putting their signature on the document.
Wow. See, that set of facts creates a massive legal knot. I mean, you're dealing with a disputed contract, a complete halt in expected payments, and an underlying activity that is fundamentally prohibited by law.
Right, managing investments without a regulatory license.
Exactly.
It's like handing your car keys to a valet who promises to, wash your car and upgrade the engine while you eat dinner.
That's a good way to look at it.
But when you come out, they deny ever taking your keys. The fact that the valet was unlicensed doesn't mean he gets to keep the car, right?
You'd certainly hope not.
Right. But in a financial context, if the underlying activity violates the rules so blatantly, I'd imagine there's a real fear the court might just look at the illegality of the whole arrangement and, well, throw the case out, leaving the investor totally stranded.
And that tension is exactly what makes this area of law so complex. Does the illegality of the manager's unlicensed status somehow extinguish their fundamental duty to return the investor's property?
So how does the UAE judiciary pragmatically resolve this?
Well, to understand the mechanics of that, we're looking at a highly determinative 2024 judgment from the Dubai Court of First Instance.
Okay.
Facing this complex financial dispute and, a denied signature, the court took a standard and really highly effective procedural step. They appointed a financial expert.
Let's talk about that expert for a second. If the manager is actively denying the contract exists and the money went directly into a commingled personal bank account, how does a financial expert actually piece together reality out of that mess?
It's tough.
I mean, it's not like there's a neat corporate ledger to audit, right?
Right. But the appointment of a financial expert is really a cornerstone of commercial litigation in the UAE. Their job is to forensically reconstruct the relationship from the ground up, bypassing all the verbal disputes.
So they don't just ask for the contract.
They follow the money. Exactly. The expert pulls the bank statements, analyzes the specific inflow of that significant sum deposited by the claimant, and then they meticulously trace the outflow. In this case, they actually found that single partial return payment the defendant made, and they matched it chronologically to the timeline of the disputed agreement.
Oh, wow. So the paper trail of the money itself starts acting as the framework of the contract.
It establishes the undeniable flow of funds. And this forensic investigation led to 3 crucial findings that really shaped the judgment.
Which were?
First, a contractual relationship did indeed exist based on that flow of capital. Second, the funds were demonstrably deposited by the claimant, and a partial return was made by the defendant.
And the third?
The third finding regarding the regulatory aspect was that the defendant was operating entirely without the mandatory accreditation from the Securities and Commodities Authority, or the SCO.
So the manager is caught completely outside the regulatory perimeter.
Completely.
But wait, the manager's main defense was, I never signed this contract. Even with a paper trail showing money moving back and forth, if there's no verified signature, how does the court hold them to the specific terms of a denied document?
Well, the court handled this through a very objective evidentiary assessment. During the expert's investigation, the defendant made a critical error in their defense strategy. They explicitly admitted to the expert that they received the funds into their personal bank account.
Oh, you can't do that.
No, you can't. So the court used this admission to completely nullify the denial of the contract. I mean, the logic applied here is airtight.
Because you cannot deny the existence of an agreement while simultaneously admitting to receiving the precise funds stipulated in that very agreement.
Exactly. The admission creates an estoppel. It traps the defendant in their own contradiction.
You cannot have it both ways. You can't ask the court, what contract, while admitting you're holding the exact bag of cash the contract describes.
Right.
But that brings us back to the licensing issue. Does the lack of an SEA license mean the deal is void and the investor's money is just gone?
No, because the court applied a very fundamental civil law concept here. A bad license does not give you a free pass to retain funds unlawfully.
That makes sense.
You still have a duty of good faith to return what isn't yours. The foundational legal doctrine here is that agreements must be kept. Lacking a regulatory license does not, under any circumstances, extinguish the fundamental duty to return someone else's money.
Okay.
So the court ultimately ordered the restitution of the remaining principal sum.
Okay, hold on. The investor gets their principal back, but what about that guaranteed, exceptionally high quarterly return they were promised? If the court is enforcing the contract to give the capital back based on the admission, shouldn't it enforce the profit clause too? It seems almost contradictory to enforce half a contract while ignoring the other half.
That touches on a core aspect of public policy and really how courts police the legality of agreements. The court scrutinized that guaranteed high-yield profit clause and recharacterized it legally.
Recharacterized it how?
Well, under the Penal Code, an agreement for a fixed, guaranteed return on capital between natural persons is classified as prohibited usurious interest.
Wait, really? Just because it's guaranteed?
Yes, because it was a guaranteed percentage on the capital itself, totally disconnected from the actual performance or risk of any underlying investments, so the court struck it down entirely.
Okay, so they severed the illegal part of the contract. They cut out the prohibited interest because you can't guarantee a return on risk capital, but they saved the core obligation to return the initial money.
Precisely.
But that means the investor's money was locked up for a significant period with zero growth. Did they just get the flat principal back after all that time?
Not exactly. The court recognized the time value of money. So while they struck down the prohibited contractual interest rate, they replaced it with the standard statutory legal interest rate, running from the maturity date of the agreement.
Oh, I see.
This ensures the investor is still compensated for the time they were deprived of their funds, but strictly within the bounds of lawful commercial practice, rather than, some illegal guaranteed yield.
Got it. Now, what about that partial payment the manager made early on, the one they originally labeled as profit?
The court strictly calculated that single prior payment, not as a payout of investment profit, but simply as a partial return of the initial capital.
So they just deducted it.
Yep, they subtracted that payment from the initial deposit and ordered the defendant to return the exact difference.
The investor also asked for a significant amount in additional damages, didn't they? I'd imagine dealing with a manager who takes your money, stops paying, and then denies the contract even exists causes quite a bit of distress or lost opportunity.
You'd think so, but the court dismissed the claim for unproven damages, which highlights a strict, objective principle in civil litigation: you have to prove actual harm.
So you can't just claim general distress.
No, the court applies the foundational pillars of tort and contractual liability. You need fault, you need damage, and you need a direct causal link between the two.
And the claimant didn't have that.
The claimant failed to provide actual evidence of specific, quantifiable harm suffered beyond the loss of the principal itself. So without that evidentiary foundation, the court objectively dismissed the damages claim.
I mean, it is great that the court retroactively rescued this investor's capital through that forensic process.
Absolutely.
But realistically, nobody wants to spend the time and resources in litigation just to get their own money back.
No one.
Which begs the question, if this manager had actually been operating within the law as a licensed entity, How would the regulatory system have prevented this blind spot in the first place?
Well, the current regulatory framework, overseen by bodies like the SCA, the Central Bank of the UAE, and Dubai's Virtual Assets Regulatory Authority, or VARA, is exceptionally robust.
Right?
If we apply their rulebooks to the facts of this case, the violations are just systemic. Informal arrangements are entirely prohibited for licensed virtual asset service providers, or VASPs.
So they can't just operate on a handshake and a WhatsApp message.
Definitely not. The regulations demand formal, transparent, and compliant client relationships from day one.
So a licensed entity cannot just take a client's money and promise them incredible returns without checking if they can actually handle the risk of the crypto market.
Exactly. Licensed entities must conduct rigorous suitability assessments. They have to deeply understand a client's risk tolerance, their investment experience, and their financial reality before taking on a mandate.
That makes a lot of sense.
And furthermore, when it comes to marketing, promising a guaranteed fixed return on highly volatile assets like cryptocurrency is a flagrant violation of VIRO's market conduct rules.
Because it's inherently misleading.
Exactly. Communications from a licensed VASP must be fair, clear, and prominently disclose the risks and extreme volatility of digital assets.
You just can't market digital assets like a zero-risk savings account because that simply doesn't reflect the reality of the asset class.
Right.
Let's look at the operational side of our case study. The manager took the investors' funds into their own personal bank account.
Under the VASP framework, how is that handled?
Commingling funds is arguably the most severe operational violation possible. The regulatory framework mandates absolute asset segregation.
So a hard line between their money and client money. A very hard line. Client money must sit in designated, legally isolated client accounts. It can never touch the VASP's own operational funds.
How does that segregation actually work for the digital assets themselves, though? I mean, it's one thing to have a separate fiat bank account, but crypto is inherently digital. It's easily transferred across borders in seconds.
That's where the tech comes in. When a VASP takes custody of digital assets, they're subject to institutional-grade security requirements. The SCA guidelines mandate sophisticated protocols for private key storage and settlement arrangements.
Like what, specifically?
This typically involves multi-signature wallets and cold storage setups where no single individual has the power to unilaterally move the funds.
Oh, so you need multiple keys to approve a transaction.
Exactly. The goal is to ensure that even in the event of the VASP's insolvency, the client's assets are identifiable, completely segregated, and legally protected from the VASP's own creditors.
In our case study, the investor was totally in the dark about what was happening with their money. How do regulators force a VASP to prove they are actually managing the money properly and not just, sending reassuring emails?
They solve this through mandatory record keeping.
Yeah.
The regulations mandate immutable audit trails. A VASP must be able to produce transaction hashes, exchange confirmations, and comprehensive periodic statements.
Right.
The central bank regulations, for example, require monthly statements detailing every single transaction and fee.
Unpack that mechanism for me. Because if I am an unlicensed manager running a scheme, I can just open a word processor and make a fake PDF statement that looks highly professional. How does a transaction hash prevent that kind of deception?
Well, because blockchain ledgers are public, a transaction hash is a unique cryptographic identifier for a specific movement of assets on that public ledger. So a licensed VAST cannot just send you a customized fake PDF. The regulations require them to give you the actual transaction hashes.
Meaning I can verify it myself.
Exactly. You can take that hash, plug it into a public blockchain explorer, and independently verify that your asset is sitting exactly where they say it is, and that the trade actually happened at the specified time and volume.
Wow, so the entire regulatory framework is systematically designed to replace blind trust in an individual with verifiable transparency. You don't have to just hope they're doing a good job. The system requires them to hand over the cryptographic proof so you can check it yourself.
Exactly. The regulations build an environment where the kind of opaque, informal dealing we saw in the court case is just structurally impossible for a licensed entity to maintain.
Okay, so we've looked at the legal problem, the judicial analysis, and the regulatory guardrails. Let's shift to a forward-looking, preventative perspective for you.
Yes, the transactional architecture.
Right. If you're a sophisticated commercial party, how do you architect a digital asset management contract so you never end up relying on a court-appointed expert to piece together your bank statements?
It requires moving away from crude, informal documents and building a really interlocking contractual architecture. Sophisticated parties mitigate risks, starting with the very first clauses, representations and warranties.
Okay.
You draft a provision where the manager affirmatively represents that they hold all necessary licenses and accreditations from authorities like the SCA or the VARA.
But putting that in writing doesn't magically make it true. What happens if they just lie in the contract to get your capital?
You make those representations a strict condition precedent to the agreement.
Meaning what exactly?
If this representation turns out to be false, the contract dictates that it triggers immediate termination and shifts all liability back to the manager. You aren't leaving compliance to chance, you are baking it into the legal foundation of the relationship.
So you lock down the licensing.
Yeah.
But how do you architect the compensation? Because we saw how the guaranteed high return trap played out earlier. The court struck it down as usurious interest.
Right.
How do you pay a crypto manager legally and effectively without running afoul of the penal code?
Instead of a guaranteed return on capital, best practices dictate a multi-tiered fee structure based strictly on services rendered.
What does that look like?
This typically involves a modest fixed management fee, which covers the operational overhead, combined with a performance fee.
I imagine that performance fee has to be structured very carefully to not look like a guaranteed yield in disguise.
Oh, absolutely. The performance fee must be based only on actual net digital assets generated. The contract must meticulously define this calculation. It cannot be based on gross gains.
Because that would ignore the costs of doing business.
Exactly. You must deduct all operational costs, transaction fees, network costs, slippage to arrive at the true net profit. Furthermore, it often includes a high watermark to ensure the manager isn't paid twice for recovering from a loss.
Oh, that's smart.
Yeah, the manager's fee is a percentage of that specific realized net gain. This legally frames the payout as a shared reward for successful management services, completely distinguishing it from an illegal guaranteed yield on a loan.
So the manager only makes the big money if they actually generate real, quantifiable profit. But even with the right fee structure, you still have the operational risks of custody.
Definitely.
You mentioned earlier that taking funds into a personal account is a hallmark of an amateur operation. How does a sophisticated contract legally handle asset custody?
The contract must mandate asset segregation as a non-negotiable operational protocol. Best practice is often to require that assets be held in a customer wallet,
Which is?
a digital address exclusively earned and controlled by the client. If the manager needs temporary control to execute trades, the contract should require a designated securities account, legally recognized as holding financial assets entirely separate from the manager's own property.
And presumably this is where the technology-driven reporting comes in. A solid contract doesn't just ask for a monthly summary, right? It demands remote monitoring access.
Oh, yeah. We are talking about electronic confirmations for every single trade executed, often tied via API to a live dashboard.
Wow, wait, so the contract demands API access to a live dashboard. That is a massive leap from a standard PDF report. How do you even enforce that legally if the manager just decides to, turn the API off or revokes your read-only access?
You tie the technological access directly to the legal triggers we discussed earlier. The contract specifies that revoking API access or failing to provide real-time reporting is an immediate event of default.
So you can pull the plug instantly.
Exactly. It legally empowers the investor to instantly terminate the agreement, revoke any trading authority the manager has over the designated securities account, and recall the capital. By combining strict representations, compliant fee structures, and technologically enforced reporting, you really eliminate the ambiguity that fuels litigation.
This deep dive has been incredibly enlightening. I mean, we started with a scenario that sounded like a total loss for an investor and unpacked how the legal system meticulously protects them, even when the paperwork is flawed or actively denied.
It's a powerful system. And to summarize our takeaways for you today, the UAE judiciary ensures restitution and protects capital, even when agreements are unlicensed or actively denied by the managing party.
Right.
The courts will utilize expert financial analysis to uncover the truth of the fund flows and apply fundamental civil law duties to ensure money is returned. However, they will also actively police the legality of contracts, striking down non-compliant profit structures like guaranteed returns on capital.
Which is crucial to remember.
Ultimately, robust regulatory compliance and precise transactional architecture are your absolute best defenses against these inherent risks.
The court's decision to enforce the return of capital, despite the defendant's regulatory violations and denial of the contract, underscores a pragmatic focus on restitution and investor protection. It demonstrates how a party's conduct, including admissions made to a court expert, can create an estoppel that prevents them from refuting the existence of an agreement. At the same time, the judgment affirms the court's role in policing the legality of contractual terms, striking down a profit clause it deemed usurious. This case relied on a combination of a written, albeit disputed, agreement and the defendant's crucial admissions. The following chapter moves deeper into the evidentiary challenges of unwritten agreements, illustrating how a party's own admissions in electronic communications can become the dispositive evidence that establishes liability, transforming informal WhatsApp messages into a legally binding acknowledgement of debt.
It really sets the stage perfectly for the next step in the process.
That brings us to the end of our discussion on Chapter 15. This chapter's structure is the standard methodology used throughout the book.
Authored by Mahmoud Abuwassel, and drawing on analysis from over 100 judgments, UAE crypto litigation serves as an indispensable resource for those in the digital asset industry.
To read the full analysis for this chapter and to explore the complete 7-part life cycle of a commercial dispute covered in the book, please visit www.uaecryptolitigation.com.
The discussion in this podcast is for educational and informational purposes only and does not constitute professional advice or any other professional relationship. Please consult with a qualified professional for advice tailored to your specific situation.